Hello everyone, this is Darshan of Dorsey Intel. I'm an analyst, trader, strategist, you name it, specializing in the S&P 500 and the SPY ETF options, and I am here today to do my first YouTube webcast. So thank you for joining me today, and let's take a quick run through the markets. So what do we have? This is my favorite site here, finviz.com. Gives you plenty of awesome data all in one place. As you can see, we've got a ton of different stocks, alerts that come up, heat maps, and charts of the main indices, including some breadth indicators as well. Percent of stocks above 50-day, 200-day moving averages and such. So a very, very handy site for kind of cramming everything into one place so you can soak it up quickly and focus on your trading and investing. So it looks like the markets were up marginally today. NASDAQ Tech was leading out with S&P not far behind and Dow taking up the rear, but overall a green day. As far as economic reports go today, we had some disappointments. ADP, not as many jobs added as expected. Productivity was down slightly, and unit labor costs were actually negative in the red versus expectation of flat. ISM services was the one bright spot, up 59.3 versus 57.5 expected, and 57.1 on the last print. And for those energy bulls out there, we had a big save on crude inventories. Supplies were down almost 3.7 million barrels versus a surplus of almost 2 million barrels at the last reporting. So we are finally seeing a turn in crude, at least the West Texas Intermediate crude, after a big sell-off over the last few months. So something to keep in mind. We may be seeing a large shift in trend for energy. Although natural gas, being the independent asset it is, could be on its own program still. So something to keep an eye on. Okay, in terms of overall futures, we are looking at we're sorted by 9-day relative strength here. In terms of currencies, King Dollar is on top, and we have the yen and peso trailing. Looks like right now, relative strengths, the only currency we really want to be long right now, over 50-55, is the US dollar. So long dollar, short the rest of the currencies. Getting back to energy here, looks like all energies in terms of relative strength are still not anything you want to be long. Although it looks like ethanol has come above its 50-day moving average, or it is above its 50-day moving average, and green on the month. So other than that, still want to probably steer clear of energy. Financials, bonds, looks like we are seeing strength in the 30-year T-bond. And right now the 10-year and the 5-year US Treasury note are marginal. So yeah, definitely be wary on anything except for the long bond. And in terms of our indices, looks like everything is pretty strong on the US end of things. Let's resort here. And looks like yeah, even the small caps are keeping up. So all is good so far on that. And in the precious metals, looks like we're finally getting some strength in everything from gold to silver. Looks like copper, the most industrial of the three, is not something you want to be long. But other than that, take a look at gold and palladium, showing some relative strength, and they're above their 50-day moving averages. So looks like we could be seeing a turn in precious metals as well as energy. Keep an eye on those. All right, in terms of relative assets, a very useful way of assessing these is comparing the ranking of a bunch of key sectors, everything from staples, precious metals, gold, which we just looked at, the S&P 500. We've got everything major here ranked in terms of 1 month performance. But what we can do is look at, okay, we've got a lot of strength right now in the home builders, consumer discretionary, transports. And then if we took a look at where those were on the quarter, it looks like they were quite a bit lower. So that is a good sign. That means that if you're going to be long assets, you're probably going to be okay in very higher beta, higher risk, but also a lot of growth potential. So again, U.S. home builders, consumer discretionary, and transports, which includes railroads, airlines, you name it. So definitely keep an eye on those. It looks like our losers are utilities, the European index. Small caps are actually way in the rear. And then trailing the most are high yield bonds. This is something to keep an eye on here because typically these high yield junk bonds are a market leader. So whatever these are doing, usually the U.S. equities and large caps finally catch up to it. So if these have been underperforming, yeah, we see really weak relative strength, 41. They're down to the month and the quarter, and they're starting to see some more volatility. So that is definitely a sign of caution going forward. And then rounding out the bottom of the list are emerging markets, Japan, and energy stocks. So if you've got those and you're not ready to sit tight, it doesn't look like they're going to be improving anytime soon. So definitely be wary of what looks like international exposure and those junk bonds. All right. Let us take a look at volatility, because that's what I wanted to kind of give you guys a little bit of a warning about today. So volatility is measured by the VIX, which is basically the options buying activity on the S&P 500, the largest U.S. equity index. So depending on the risk appetite of investors, people will buy or sell options. So basically they're hedging the risk on this major blue cap index. And the VIX is basically an indicator of kind of the balance of those forces. So when the VIX is high, it means people are buying lots of protection, buying puts, panicking, selling their stock. It's just ugly. Whereas when the VIX is low, there's what you would call complacency in the market. Things are cruising along. You know, you're not necessarily seeing huge gains every day, but things are fine. And so in this case, we're definitely down in that level. We're knocking on the door with the 11 handle, but we've basically held in the mid-12s for the last month. Our last daily closing low was on the 26th of November, a few days ago. But something to keep in mind is it's because of the cyclicality of the VIX, you'll see these different peaks, which are usually separated by anywhere between 40 and 50 trading days. And a good way of doing that is to look at how many days the VIX has been below its 33-day moving average. You can pick a 20, you can pick a 50. I prefer the 33. That's what I've done studies on. And if we look at how many days we've been beyond that, we're measuring 31 days, it looks like, that we've been below that 33-day moving average. So we've been basically rallying since that mid-October low in the markets. So going back to our study of basically VIX and its runs above or below this average over the last decade plus, if we look at where 31 puts us, it puts us basically in the top 28% cumulatively of occurrences. So this is a very long run of low volatility, essentially. And if we looked at where we've seen a trough, because you can basically calculate with a high degree of precision where the peaks and troughs are going to be in your average cycle, if you know the length of it. So in this case, we are 25 days. We saw our trough several days ago, and 25 puts us somewhere between 33 and 39 days. So if we're at 31 and we're looking at maybe 37, 38 days, that means we only have maybe another trading week left before our lowest VIX daily close is expected. And also, like I said, we're already in this red zone where the probabilities of this run continuing are diminishing rapidly. So stay on alert for some volatility, volatility upswing, which means that risk assets like stocks, potentially shorter duration bonds, will be sold when volatility starts to rally again. And that could happen within the week. So we're going to use a tool that I developed just to kind of look at a forecast of where the VIX could go over the next week or two. And I know from a metric that I've got on my C-suite here, which I am running a holiday special and we'll get back to that. But on the C-suite here, basically a model of where the S&P is going to go over the next 3 weeks, plus some other volatility and expected change metrics. And we actually have a metric which is VIX 1 month volatility. So basically the first derivative of volatility itself, and where that's gone. And typically how this indicator works, we'll see back here in that October low, which we've referenced a couple times here, 1015, 1016. We saw the bottoms in the SPX, and we also saw a high here of about 1 month volatility in the VIX of nearly 25%, 24, 25%. So generally when this indicator is very high, that means that VIX is kind of topped out and that volatility will start coming down. The selling's done. So typically when this is high, it's time to buy. But when it starts getting low and you see this extended run of low volatility like we've had for the last month plus, that's when it's time to start being wary. In fact, we've crossed below kind of a critical threshold around 5.5%. Today we hit 5.44%. And in fact, if you look at the mid-September S&P high, we were right around this level, 5.4, 5.5, before the big sell-off there. So that's definitely something to keep an eye on. But to get a more specific forecast of where the VIX could be taking us over the next week or two, if we do see an uptrend, we're going to take that 5.44 and we're going to compare it to the S&P's realized volatility right now, which is about 0.54. And we're saying the VIX is going up, and our base is about 12.65. And we'll say that the turn comes by Friday. So we'll see our low and start rallying from there. And it has been, so we want to know basically how many days has it been since we had a week of very rapidly accelerating volatility. And that threshold based on this calculation and the model is around 11%. So we were above that right about here on October 20th. And we're going to see how many days it's been since then, 31. And if we're talking Friday, that's another 2 days, so that'll put us at 33. So it's been 33 days since our last volatility outbreak. Running the calculation, and we get a nice probability chart here. So basically what this is telling us is our VIX upside for the next 1 to 2 weeks between December 12th and the 19th, starting from 100% or the highest probability up here in the top left, and then basically going down. And it looks like we have a chance of getting above 18, 20% and lower. The 10% threshold is a VIX of almost 20. So if you recall the last time we broke 20 and things were getting really ugly, there's actually around a 10% chance of reaching that level or even higher. Although typically we don't, you don't see price action above or below this 10% probability threshold very often. So looking at our 50, so we're looking at anything from above 16 all the way through 20 is very possible within the next week or two on the VIX. So definitely be wary with risk, maybe raise a little bit of cash. In terms of What is looking stable on the stocks right now? Looks like it's mostly life insurance. Lots of life insurers here. Looks like some electronics.